Every single financial transaction in a business, whether you're buying, selling, paying, or receiving, has to be recorded somewhere first. So today, let's dive into this explainer and translate every single one of those business transactions into the official language of accounting. We are going to unpack the journal, which is quite literally the foundational chapter in the principles of accounting. We'll cover the whole shebang, from the format and the golden rules, right down to the actual journal entries with real practical examples. Let's get into it.
Before we can even think about ledgers, trial balances, or looking at final financial statements, we have to start with the very first step of the whole accounting cycle. And that step answers this exact question. Where does it all begin? Because without this crucial initial step, the entire financial picture of a company simply cannot be processed or understood. All right, so here is our roadmap for today's explainer. We'll start with the book of original entry and the anatomy of a journal. Then we'll dive right into the rules of debit and credit, apply those rules using our steps to journalize with some practical examples. And finally, we'll look at some common mistakes to avoid. Trust me, if you get this foundation down properly, everything that comes after it is going to be so much easier. Section 1. The book of original entry, the business diary. Let's look at how a business actually keeps a daily record of its financial life. I want you to think of the journal as a literal diary for your business. In fact, it's often called the daybook. It's the book of original or first entry, where every single business transaction gets written down in chronological order, so date-wise, before it ever makes its way over to the ledger. And just so we're on the same page with the terminology, the actual process of recording these transactions in this book is known as journalizing. Moving to Section 2, Anatomy of a Journal, the 5 columns. What's really interesting here is how highly structured this diary actually is. A standard journal always features these 5 exact columns. First, you've got the date, showing exactly when the transaction happened. Then, the particulars, which details the specific accounts involved. Next up is the ledger folio, or LF for short, which basically acts as a page reference for where this entry will eventually live in the ledger. And finally, you have the debit and credit columns for your amounts. Also, pay attention to the particulars section, because it requires a short explanation in brackets at the very end of the entry. We call this the narration, and it's basically just a brief, plain English summary of what just happened. Section 3. Rules of debit and credit, the core principles. So how do we actually decide what numbers go into those columns? Well, before we can journalize anything, we absolutely have to classify our accounts. Under the traditional, or British approach, accounts are divided into 3 distinct categories. First, we have personal accounts, which relate to people or organizations, like a customer named Ahmed or a specific bank. Second, real accounts, which relate to your assets and properties, like cash or furniture. And third, nominal accounts, which handle all your expenses, losses, incomes, and gains. So things like rent or salary fall into this bucket. Now, these right here are the famous golden rules of accounting. They brilliantly show how every single action has an equal and opposite reaction. For personal accounts, debit the receiver, credit the giver. For real accounts, debit what comes in, credit what goes out. And for nominal accounts, debit all expenses and losses, credit all incomes and gains. Remember, every transaction will touch at least 2 accounts, balancing out perfectly. Now, while those golden rules are historic, many modern textbooks use the American or modern approach instead, which relies heavily on the accounting equation. Under this modern system, assets and expenses increase with a debit and decrease with a credit. Conversely, liabilities, equity, and revenue decrease with a debit and increase with a credit. Impartially speaking, though, neither method is inherently better or worse. Both are going to give you the exact same final journal entry. You just go ahead and use whichever method clicks best for you or whatever your curriculum requires. Section 4. How to journalize transactions, 4 actionable steps. The crucial point here is taking those rules and turning them into a repeatable workflow. So, whenever you're facing a new transaction, just take a breath and walk through these 4 logical steps to make sure you're totally accurate. Step 1. Identify the 2 accounts involved. Step 2, determine the type of each account. Is it personal, real, or nominal? Step 3, apply the corresponding golden rule to figure out which one gets debited and which gets credited. And step 4, finally record the entry in your journal with the date, the amounts, and of course, that all-important narration. Section 5, practical business examples, putting it into practice. Let's see how all of this builds together by looking at a business in motion. Let's imagine you're opening up a brand new tech repair shop. Day 1, you inject cash into the business. The action is
Start a business with cash, 100,000 rupees. Using our rules, cash is an asset, which makes it a real account. It's coming into the business, right? So we debit what comes in. Now the capital account represents you, the owner, a personal account giving to the business, so we credit the giver. Therefore, our cash account is debited for 100,000 and our capital account is credited for 100,000. Easy enough, right?
Okay, so the shop is open. Day 2, we need some inventory. The business purchased goods for cash, 20,000 rupees. Now, when a business deals in commodities daily, we specifically denote them as purchases when they come in. As an expense, this nominal account gets a debit. Meanwhile, cash, our real account, is going out the door to pay for it, so we credit that. The final entry, purchases account debit to cash account credit. Moving on to day 3, what about selling goods? But, not getting paid immediately. Let's say we sold goods on credit to our first major client, Ahmed, for 15,000 rupees. Here, Ahmed is a personal account. He's the receiver of the goods, so we debit the receiver. On the other side of things, we use our sales account. Sales is an income, which is a nominal account, so we credit all incomes and gains. Ahmed account debit to sales account credit. Day 4, we've got to keep the lights on and pay some bills. The business paid rent of 5,000 rupees in cash. Rent is a classic nominal account expense, which means an automatic debit. Our real account, cash, is leaving the business, so we credit what goes out. The entry reads, rent account debit 5,000 to cash account credit 5,000. Day 5. Sometimes things happen at the exact same time. Let's say we paid 10,000 for salary and 5,000 for rent together on the same day. This brings us to a really neat shortcut, the compound journal entry. Instead of writing out 2 separate entries, we just combine multiple debits, in this case, salary and rent, into a single transaction. Salary account debit 10,000, rent account debit 5,000, perfectly balanced by one total credit to cash for 15,000. It's super efficient and keeps your ledger looking incredibly clean.
Section 6. Avoiding common mistakes, pitfalls to watch out for. Before we wrap this up, I really want to highlight the most common hurdles that both students and professionals face in this chapter. You definitely want to avoid these common traps. A massive one is confusing the debtor and creditor when you're making credit transactions. Always try to trace it back to who is actually receiving and who is giving. Another one, forgetting to write the narration. Honestly, leaving that out will cause massive headaches for your future self when you try to review the books later. Applying the wrong golden rule, like treating a regular expense as a physical asset, will throw your logic completely off. And lastly, not maintaining chronological order. Remember, the journal is strictly a date-wise record. If you jump around, it completely defeats its purpose as the business diary.
All right, let's do a quick recap. The journal is the foundational daybook of a business. It captures the entire financial story exactly as it happens. By applying these strict rules, whether you prefer the traditional or the modern approach, we ensure that for every bit of value transferring in, an equal value transfers out. Every debit has an equal credit. Getting this right is absolutely crucial because making a mistake here leads to a cascading disaster in your financial statements later down the line, and nobody wants angry auditors. I'm going to leave you with that provocative thought to ponder. We have this huge list of dates and debits and credits, right? But how does all of that ultimately show us the true financial health of a company at year end? Mastering the journal is just the key that unlocks the rest of the accounting cycle, which we are absolutely going to explore in our future explainers. Keep learning, keep analyzing, and I'll catch you in the next one.